When it comes to investing, stocks get all the love, all the headlines, but you want to know where the really smart money often looks? Bonds. They're not just some quote unquote safe option, they are a super powerful tool for generating income and playing defense. So, in this explainer, we are going to give you the consultant's playbook for bonds, a really clear, structured way to understand them, analyze them, and make them a key part of your financial strategy. Okay, so here's our game plan for today. We're going to kick things off with a why. The two main jobs a bond is really designed to do. Then we're going to map out the entire bond universe using a really clean logical framework. After that, we'll give you an analyst toolkit, show you how to actually get into the market, and then we'll wrap up by talking about the key risks you need to navigate. It's the whole journey, from high-level strategy right down to the nitty-gritty. All right, let's start with the most important question of all. Why would you even own bonds in the first place? Before we get into all the different types and how they work, you've got to understand the two fundamental roles a bond plays. If you get this right, everything else just clicks into place.
At its heart, a bond is incredibly simple. Seriously, it's just a loan. You, the investor, you're the lender, and a big corporation or government is the borrower. They promise to pay you back the original amount, that's the principal, on a specific day in the future called the maturity date. And for letting them use your cash, they pay you interest, called coupons, usually at regular intervals. That's it. That's the whole deal.
So, from that very simple loan structure, bonds give you two really powerful things. First, they're an income engine. That steady, predictable stream of interest payments, that's the lifeblood for anyone who needs consistent cash flow from their investments. But second, and this is so crucial, they are a portfolio stabilizer. See, bonds often move in the opposite direction of stocks. They act like a shock absorber. So when the stock market is going haywire, a solid chunk of bonds can be the bedrock that keeps your entire portfolio from sinking. Okay, so we know why we want bonds. Now let's figure out the what. To get our heads around the massive world of bonds, we're going to use a classic consultant's tool, the MISI framework. It's a bit of jargon. It stands for mutually exclusive, collectively exhaustive. But really, it's just a fancy way of saying we're going to categorize everything with no overlaps and no gaps. It's honestly the cleanest way to see the whole landscape. And the absolute clearest way to do that is to ask one simple question. Who is issuing the debt? See, every single bond out there is issued by one of two types of entities, a government or a corporation. That simple split, right there, is our top-level MISI framework. It's a clean, comprehensive starting point for navigating the entire bond universe.
Okay, let's dive into the government bucket. At the very top, in terms of safety, you have U.S. Treasury bonds. They're backed by the full faith and credit of the U.S. government, which basically makes them the global gold standard for a risk-free investment. Then you've got municipal bonds, or munis. These are issued by states and cities to fund things like schools or bridges, and their superpower? The interest you earn is often completely tax-free. Then there are agency bonds from groups like Fannie Mae. They offer a little more yield than treasuries for a tiny bit more risk. And finally, you can go global with international bonds, but you have to keep an eye on things like currency swings and the political situation in that country.
Now, flipping over to the corporate side, things get even more interesting. You have your standard bonds from huge, stable companies like Apple or Microsoft. The risk there is pretty much tied to how well that company is doing financially. A really cool and growing area is green bonds, where companies raise cash specifically for eco-friendly projects, like building a new wind farm. And then you have the high-risk, high-reward stuff, high-yield bonds, which, people often call junk bonds. These come from younger or maybe less financially stable companies, so they have to pay you a much higher interest rate to convince you to take on that extra risk. All right, so we've got our map of the bond universe. Now you need the tools to actually navigate it. When you're looking at a specific bond, how do you size it up? Well, there are three critical levers of analysis you need to pull to really understand its risk and potential reward. These are the three questions you absolutely have to ask for any bond. Number one, credit quality. Basically, how likely are you to get paid back? Rating agencies like Moody's and S&P give bonds grades from AAA, which is rock solid, all the way down to junk status. Number two, interest rate dynamics. How is this bond's price going to react if interest rates in the wider economy go up or down? This is probably the biggest force in the entire bond market. And number three, maturity. When does the loan end? A 2-year bond is way less sensitive to rate changes than a 30-year bond is.
And that brings us to what is maybe the single most important dynamic in the bond market. This inverse relationship between a bond's price and its yield. If you get this one concept, you understand the engine that drives pretty much everything. So let's just ask the question directly. Think about it like this. Imagine you own a bond that pays you a 3% interest rate. Now, let's say the Fed raises interest rates, and suddenly new bonds are coming out that pay 5%. Well, your 3% bond doesn't look so hot anymore, right? Nobody would pay you the full original price for it. So for your bond to even have a chance of selling on the open market, its price has to fall until that fixed 3% payment gives a new buyer a return that's competitive with the new 5% bonds. And this perfectly captures that core mechanic. It really is like a seesaw. If the price of a bond goes up, its yield goes down. If the price of a bond goes down, its yield goes up. They are mechanically and forever linked. This inverse relationship is the constant force you always have to be thinking about with bonds. All right, we've got our map, we've got our toolkit. Now let's talk about execution. How do you actually get in the game and put all this knowledge to work? Well, there are really two main paths you can go down. So your first big choice is structural. Do you want to buy individual bonds or invest in a bond fund? Buying individual bonds gives you total control, and there are no ongoing management fees. But you'll probably need a good bit of cash to build a properly diversified portfolio. On the other hand, bond funds, like ETFs or mutual funds, give you instant diversification for a really low cost of entry. The trade-off is you'll pay a small annual fee for that professional management. Honestly, for most investors, funds are the most practical way to get started. Your second choice is all about your mindset. Are you an investor or are you a trader? The classic investor strategy is holding to maturity. You buy a quality bond, and you just hold it until the very end, collecting all those interest payments and then getting your principal back. It's a strategy built on predictable income. The other path is active trading, where you're trying to profit from short-term price swings. This is a much higher risk game. That's all about capital gains, not income. And finally, any smart investor knows the risks just as well as they know the rewards. It's not enough to just see the upside. You have to see the potential problems coming. So let's frame the big bonds risks as headwinds that you just need to be ready to navigate. You're pretty much always managing these three big ones. We've talked a lot about interest rate risk. That's the seesaw effect. Next up is inflation risk. If your bond is paying you a fixed 3%, but inflation is running at 4%, you're actually losing purchasing power. Your money just doesn't go as far. And finally, the most obvious one, credit or default risk. This is just the raw risk that the company you loaned money to goes bankrupt and can't pay you back. So you're managing risks from the market, the economy, and the issuer itself. Now let's just quickly touch on a specific, sometimes tricky kind of risk called call risk. You won't find this in every bond, but it's a really important feature to watch out for, especially with corporate and agency bonds.
So a callable feature basically gives the borrower a huge advantage. Let's say they issued a bond paying you 6%. But a few years later, market rates drop to 3%. They can call the bond back, which just means they pay you off early. Now that's great for them because they can turn around and borrow new money at that cheaper 3% rate. But it's bad for you. You get your money back, sure, but now you have to reinvest it at the new, lower rates. And that nice income stream you were counting on is just gone.
So there you have it, the consultant's framework for bonds. We've gone all the way from the fundamental why, income and stability, to a complete map of the bond universe, to the toolkit you need to analyze any bond out there. We've covered how to actually do it and the key risks to watch for. Look, bonds might not have the glamour of some hot tech stock, but they are the absolute bedrock of sound financial planning. So the real question now is, how are you going to use this powerful tool? Will it be your portfolio's defensive shield, its steady income engine, or maybe both?